There is no such thing as spontaneous yield. If a digital dollar pays you 10%, you are taking a risk. And if you cannot identify exactly what that risk is, you are the yield. In a market built on noise, this is structure, digital credit explained. In the previous episode, we examined the three categories of stablecoin: fiat-backed, crypto-collateralized, and algorithmic, and established that reserve composition, redemption mechanics, and regulatory status are the primary risk variables. Today, we examine the yield side of the equation. How does a dollar-denominated digital asset generate income? What are the specific mechanisms, and what risk does each source of yield actually represent? Yield does not emerge from digital assets any more spontaneously than it emerges from traditional assets. It is always the compensation for something, for the use of capital, for the acceptance of risk, for providing a service that the market values. Understanding what you are being compensated for is prerequisite to evaluating whether the compensation is adequate, excessive, or simply too good to be true. In stablecoin yield products, the income can be traced to several distinct sources, and identifying the source, with specificity, is one of the most important analytical disciplines in this asset class. The first and most structurally transparent yield source is lending. A stablecoin holder deploys their position as a loan to a borrower, an institution, a trading firm, or a protocol, and receives interest in return. The yield is the interest rate on that loan. The risk is the credit risk of the borrower, the probability that the borrower cannot repay. In well-structured arrangements, the loan is itself secured by collateral, which reintroduces the LTV and liquidation mechanics we examined in the context of Bitcoin collateralized lending. The critical due diligence question here is, who is the borrower, and what collateral secures the obligation? The second yield source is liquidity provision. Digital asset trading venues, whether centralized exchanges or decentralized protocols, require liquidity, the presence of standing buy and sell orders that allow participants to trade efficiently. Liquidity providers deposit their stablecoin positions into liquidity pools or order book arrangements and receive a share of the trading fees generated by the venue. The yield reflects the volume of trading activity passing through the pool and the depth of the liquidity provided. This source of yield introduces market structure risk. If trading volumes decline, if the venue loses competitive position, or if the liquidity pool is exposed to a phenomenon called impermanent loss, a technical risk specific to certain decentralized liquidity arrangements, the effective yield can be materially lower than the nominal quoted rate. The third yield source is real-world asset backing. In this structure, the stablecoin or the yield instrument is backed by or generates returns from traditional financial instruments held outside the digital ecosystem. Most commonly short-duration government securities, such as U.S. Treasury bills. The stablecoin or yield product passes the coupon from these instruments through to holders, often with structural modifications. This is the closest structural analog to a money market fund, and it carries a corresponding risk profile. Government securities credit risk, which is minimal for U.S. Treasuries, combined with the structural risk of the intermediary holding and managing those assets. The fourth yield source, and the one that warrants the most careful scrutiny, is strategy yield. Income generated through active management, proprietary trading, arbitrage, or other market activities conducted by the entity managing the stablecoin yield product. Strategy yield can be attractive in absolute terms, but is often the least transparent and most variable. When an entity states a high annual percentage yield without specifying the mechanism through which that yield is generated, the allocator should treat that opacity as a risk signal, not merely a gap in marketing material. The annual percentage yield, or APY, is the standard metric used to express stablecoin yield. It represents the annualized effective rate of return, compounding included. But APY is a trailing or projected figure. It reflects historical rates or model assumptions, not a guaranteed forward rate. APY fluctuates with market conditions, credit risk, trading volumes, and strategy performance. An allocator who evaluates a stablecoin yield product solely on the basis of its quoted APY, without understanding the yield source, is not practicing credit analysis. They are practicing yield chasing. Stablecoin yield has identifiable sources: lending, liquidity provision, real-world asset backing, and active strategy returns. Each source carries a distinct risk profile. The discipline of stablecoin yield analysis is to trace the income to its origin, to understand precisely what the investor is being compensated for, before evaluating whether the APY is attractive, adequate, or a warning signal. An unexplained high yield is not an opportunity. It is a question that demands an answer before capital is deployed. In the next episode, we introduce the third and most structurally complex instrument family: companies that hold Bitcoin as their primary treasury asset and issue structured credit instruments against that holding. Clarity before yield, always. Digital Credit Explained. Like and subscribe.